The biggest and most powerful central bank in the world, the Federal Reserve, has just put out a new case study scenario where they stress test the banks to see how they would perform in a severe downturn recession in 2021. In the Federal Reserve's worst case scenario, equities could fall up to 55%. In this video, I want to break down this scenario released by the Federal Reserve to see how likely it is and what we should do with this information. And of course, if this video brings you value, please hit that like button for the whole YouTube algorithm. Comment your thoughts below. How likely do you think this scenario is? And subscribe for latest economic, personal finance and investing content. So the Fed's worst case test scenario includes a 55% drop in equities. And this is in the US, but you better believe if the Wall Street or the S&P, Nasdaq, Dow Jones dropped by 50%, our markets here in Australia would plummet as well, because all the financial markets globally are now tied together. Just like what we saw in March when the Wall Street was crashing, the same thing here happened in Australia and around the world. So it says here, in the wake of the global financial crisis, the Federal Reserve has run an annual stress test on America's banks, and the 2021 test will include a scenario in which US equities plunge 55%. Wow, 55% decline in equities. That definitely would be a huge plunge. A lot of people that have got margin, they would get margin calls and it would just make a downward spiral because those people will get liquidated and then there'll be more forced selling, driving the markets down lower. Last year, the US Central Bank found that large banks were generally well capitalized under a range of hypothetical events, but due to continuing economic uncertainty, placed restrictions on bank payouts to preserve the strength of the banking sector. So the Fed this year said it will be testing 9 large banks. Small banks are on a 2-year test cycle, though they can opt in for this year's review if they want. So what bank do you think is most likely to fall? Or what bank do you think would have the most impact on the global markets, like for example if JP Morgan or Goldman Sachs went down? Banks with large trading operations will be tested against a global market shock component that stresses their trading, private equity, and other fair value positions. Additionally, banks with substantial trading or processing operations will be tested against the default of their largest counterparty. So something you should also be aware of is derivatives. There is a lot more derivatives than there are real products or real stocks or real money in the world, and if they go down, the whole system could come crashing down. The Fed made clear it's not expecting the economy or the markets to plunge. The scenarios are not forecasted, and the severely adverse scenario is significantly more severe than most current baseline projections for the path of the US economy under the stress testing period. The tests are designed to assess the strength of the large banks during hypothetical recessions, which is especially appropriate in a period of uncertainty. Each scenario includes 28 variables covering domestic and international economic activity. So what out of those 28 variables do you think could trigger this huge decline in equities? Because there are a lot of things that could trigger it. But keep watching, because soon it's going to tell us exactly what could trigger this. The intent of the tests are to help ensure that large banks are able to lend to household and businesses even in a severe recession, the Fed said. And that's a very key statement. If the banks, say for example, stop lending in the housing market, like what they did during the Banking Royal Commission in 2018, we saw how it had an immediate impact on property prices. Because at the end of the day, if people can't get a loan, they can't buy a house, and also people in a recession, they're more likely to put things on credit cards and to take up loans to get them through these hard times. But if the banks, tightened up their wallet, it definitely would accelerate the downturn. The banking sector has provided critical support to the economic recovery over the past year. And that's exactly right. Interest rates have plummeted. The banks have been giving out cheap credit. People can get interest rates below 2% now. It's absolutely crazy. So definitely what the central banks are doing when they're offering cheap credit to the private banks, then they're offering that cheap credit to consumers to help stimulate the economy right now. Although uncertainty remains, this stress test will give the public additional information on its resilience. Okay, so let's now get into the scenario where equities could fall 55%. The hypothetical recession begins in the first quarter of 2021 and features a severe global downturn with substantial stress in the commercial real estate and corporate debts. Now, this is something that I think could actually happen. The commercial real estate market is really struggling right now. A lot of people are working from home. A lot of businesses are downsizing, so there's not as much demand for commercial real estate, especially in the hospitality sector. In Melbourne, when I went there, I saw a lot of empty shops, so definitely a lot of commercial real estate landlords are going to be struggling, and there are a lot of derivatives in the commercial real estate market and a lot of debts tied to it, so this is definitely a real risk. The US unemployment rate in the severely adverse scenario rises by 4% from its starting point, reaching a peak of 10.75% in the third quarter of 2022. So this is something that already happened last year. I think it reached actually around 13%, so definitely it could happen again. Gross domestic product falls 4% from the fourth quarter of 2020 through the third quarter of 2022, with asset prices dropping sharply, including a 55% decline in equity prices. So again, gross domestic product falling by 4%. That's something that happened last year. Could this recovery be a dead cat bounce? We'd have to wait and see. Things are looking like they are recovering at the moment though. Okay, now let's get into how actually likely is this scenario and do I think will happen? Well, do I think the economy could see a W-shaped recovery? I do think it's possible after all the stimulus is taken away that we could see a weakening in the economy, or if there's further lockdowns like what's happening here in Victoria. But do I see a 55% decline in equities? No, because they're putting out this scenario and it seems like they always put out these worst case scenarios that never happen because they kind of put it out there in the public and people go, no, we can't have that. And then there's a lot of interventions. There would be more money printing by the central banks. They could possibly drop interest rates in the negative territory, and there will be more fiscal policy from the governments, like helicopter money where they give people stimulus checks or stimulus packages. Now, you're always going to see these articles come out of 50% or the coming stock market crash, and hey, eventually one day there probably will be one. But I feel like I'm obligated to give you the best information that investing for the long term, dollar cost averaging, not getting all involved in the FOMO and then the doomsday scenarios. If you just invest for the long term, you'll be better off. Just sticking to your plan. Investing in index funds is not financial advice, but just what I do. I invest in index funds, put it in there every month, no matter what the market's doing, because hey, nobody can predict the market. We thought that the stock market would crash and continue to crash last year, but it's had its best year in decades. But I think it is important for everyone to be informed of the risks that are out there in the economy. You can do your own research and figure out what's the best plan for your personal situation. So again, how likely do you think this scenario is, and will you stick to your investing plan in 2021, or are you waiting on the sidelines with some cash to hopefully get some deals? And for all my loyal viewers and subscribers still watching, you're awesome. And of course, if you haven't already, please hit that like button. It really helps out the channel a lot. Again, comment your thoughts below and subscribe for the latest economic news, personal finance and investing, and housing market content. And of course, I'll see you in the next video.